Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Hello and welcome to Wealth is in the Details with Peter Raskin from Raskin Planning Group. Peter, how are you?
I'm doing great, Eric. How about yourself?
I'm super excited because I get to say something that I've never said on this podcast before. The topic that you're speaking about, the topic you're speaking about today, I have no idea anything about it. I know nothing about this topic. So I'm super interested because it sounds interesting. And I know that you brought a guest on the show to talk about this. Is Nino Balduzzi from Griffin Capital. Peter, tell us a little bit more about this.
Yeah, it's a really interesting opportunity, I think is a good way to say it. There's been recent legislation over the last few years that offers an ability for an investor to defer potentially capital gains and potentially provide some tax-free appreciation on an investment. And so I think that sounds like a win-win.
Yeah, me too. So what is this?
Yeah, so this is an investment strategy that might benefit some of our listeners. It's something that's very specific and not applicable for everyone. But I think everyone will agree after they hear Nino and myself talk about this issue, is that it's a real interesting approach to incentivizing real estate development in very specific, what I'll call census tracts across the country. And a census tract is just an area of the country that meets certain qualifications. And so I'm real excited to have Nino Balduzzi, who's a senior vice president at Griffin Capital, join us today on a podcast. And Nino, please introduce yourself and tell us about your journey to your current role at Griffin Capital, and also tell us about Griffin Capital.
Yeah, thanks so much for having me. I really appreciate the time and the interest. I've been with Griffin Capital for actually only a little less than a year. Prior to that, I was nearly 13 years at another large investment management firm based in the Boston area. And I've been in the financial service industry for, almost 20 years at this point. Unfortunately, I feel like I'm getting older and older by the day. But in any event,
we are.
Yeah. Yeah, it goes by fast. In any event, so I came to Griffin Capital about a year ago, and Griffin is about a 30-year-old real estate firm, primarily in the development space. And we have done everything throughout our lifetime, from commercial to industrial to office and healthcare. And now we're really focused just on the multifamily space and building projects in different areas of the country where we're seeing large population growth and a real need for housing. And so Griffin has been in specifically, I'd say, in that business for the last 5 to 7 years at this point. And then we got into the topic that we're going to cover today in 2019. And I'm sure I'll talk a little bit more about that as we go along. But that's myself and a brief overview on Griffin.
Well, great. I'm so glad you're able to join us today. And I just think this topic is really interesting. Before we begin, I just want to let our listeners know that neither Nino or Griffin Capital are affiliated with Lincoln Financial Advisors, the broker-dealer that I'm actually affiliated with. And today we're not going to be talking about any specific investment offering. This conversation is really meant to educate listeners about legislation that I think might be of interest. And I'll also say that we're not giving tax advice to anyone. If there's an interest, they should really speak to their tax advisor relative to any potential investment that they want to make. So I just want to make sure that that's clear, and we've told our listeners that. Before we go into any details, let me set the scene. Many of our clients have purchased or they've inherited an asset that is appreciated in value over many, many years. Just as an example, maybe they got lucky and purchased Apple stock or Tesla stock, a long time ago. And if those stocks were sold, they would have a massive realized capital gain. Or maybe they inherited a second home from a parent 20 years ago, and now they're ready to sell it. And that property is appreciated in value. And this taxable gain could very well be significant. And it is for many of our clients. Almost every year we're facing these kinds of issues with clients. And it can be really, really important to do the tax planning around that. So if a client's built a successful business or they're selling a stock with a very highly appreciated gain, this may be a strategy that'll help those clients. Isn't that right?
We certainly think that it can be very powerful legislation, as it really provides two distinct benefits as it relates to the legislation and the investment. And the first is the deferral on the capital gains. So in the example that you laid out, if someone was to sell, piece of Apple stock that they had highly appreciated, in normal circumstances, if they had sold it here in 2023, they would have to claim that on their 2023 taxes. The Opportunity Zone legislation allows them to actually push that out if they make an investment into an Opportunity Zone to 2026 and have that payable in 27, right? So you get a little bit of deferral on that tax liability right off the bat, right? The other piece of it is tax-free appreciation on the investment. We'll discuss that further, but essentially, if you leave your investment in the Opportunity Zone for 10 years or more, you'll get a full step up in basis on the investment. So, if in an example, if you invest $1 million into an Opportunity Zone fund and just say hypothetically it grows to $2.4 million, you're always going to have to pay that tax liability on that initial $1 million in 2026, right? But that additional 1.4 million in growth will come out completely tax-free on the federal level and in most states if those states are conforming.
So now that we've set the scene, we've kind of talked about the advantages of this what's called this opportunity fund. Let's talk about how this all developed. What is a qualified opportunity fund? How did it come into its current structure? What's it all about?
Yeah, sure. So the legislation was passed in 2017 in Tax Cuts and Jobs, and it created Subchapter Z of the tax code, and it allowed governors of each state to designate certain census tracts in their states as opportunity zones. If there was investments into those specific tracts, and to give you perspective, there's about 12% of all census tracts are opportunity zones. And so if a investor invests capital into an opportunity zone, specifically around real estate, they get to realize these tax benefits of deferral and tax-free growth down the line.
And what kind of properties are being developed? What do they look like?
Yeah, sure. So, again, we specifically do multifamily, but the legislation is really around any type of real estate development. And that could be ground up or it could be rehabbing if it meets certain conditions. But it can be multifamily for housing. It can be industrial. It can be commercial. It can be retail. It's a really broad array of real estate development. It was really just designed to facilitate job creation and positive long-term economic impacts in these areas that are opportunity zones.
Could you describe kind of how what an opportunity zone really is? If I look out my office window in downtown Boston, is that likely to be an opportunity zone? I mean, what is it?
So it depends around where in downtown Boston, but a qualified opportunity zone is actually a low-income community from a census tract perspective, right? So the poverty rate for each census tract needed to be at least 20%, or if the tract is located in a metropolitan area, the median household income didn't exceed 80% of the metropolitan area's median household income. Or if the tract is not located in a metropolitan area, the median household income doesn't exceed 80% of the statewide median household income. So this was really designed to drive investments into low-income areas. And it passed with bipartisan support as part of tax cuts and jobs, but it was really the brainchild of Sean Parker, who you might know from Napster and Facebook. He'd done a lot of philanthropic work, and he really wanted to see his dollars being put to good use in these types of areas. So he was able to gather support within Washington and ultimately get this passed. Now, I will say, you think low-income areas, Section 8, things like that. There certainly are some areas where, the real need for economic development and real estate development is at a premium in those areas. However, the census tracts were drawn by the governors of each state in 2018, but they were using 2010 census data. So we were coming out of the global financial crisis. And, when they were doing these 2010 census numbers, things were not exactly really favorable in this country. You fast forward to 2018, they were using the 2010 data, and there's a lot of areas that had already seen a ton of revitalization. And the governors really used this to continue to drive development into these areas that, might have not needed it in 2018.
Hi, this is Catherine Broy from the Raskin Planning Group. Apologies for the interruption. Thanks so much for listening to Wealth is in the Details. We hope you're enjoying it so far. If you have any questions or would like to talk more about this topic, please visit our website at www.raskinplanning.com. Look for the podcast's show notes and connect with us via social media.
So the idea is that an investment fund is established that will buy or develop a property in these opportunity zones that are really designed by each state, and there may be multiple zones in any certain area.
Absolutely.
Yeah. Okay. I think just for what I know about it, this whole investment strategy and the advantages from a tax perspective are a little bit complicated. And I thought the best way to talk about it was thinking about a different phases of this process where someone, an investor realizes a capital gain, and there are different timelines. And I thought it would be helpful to have you kind of go through these different phases of this investment from a timeline perspective.
Sure. So, everyone's a little bit different, and I can, speak about kind of the multifamily life cycle, and what we're doing, specifically, but from Griffin as a whole, you might have a little bit of a different experience if you're building something that's industrial or if you're buying a project and renovating it, right? But, in general, from our standpoint, it takes us about 18 to 24 months to build a property. So we're just putting capital to work that we've brought in that clients have given us that's from, their capital gain events, right? So essentially nothing's going to happen with the portfolio at that point. And then we're going to start to lease up. And if you think about what we're building very large projects, anywhere from 300 to 500 unit buildings in desirable areas that just happen to be in opportunity zones. So after we build, we lease up, and that takes us about 12 to 14 months. And then we'd like to go out for refinancing. We're carrying construction capital on that. We go out for refinancing, and someone will give us a valuation on the portfolio. And we're able to give some capital back to shareholders at that point, because hopefully, things are going well and we've built a project for X and we're getting it appraised for Y, and that Y is higher than what X is. sort of to give some capital back to shareholders at that point. And then we're operating a stabilized portfolio in which we're kicking off income that's coming from the rents that are in the portfolio, right? Pretty diversified rental base. So that'll come on a quarterly basis through the end of the life of the portfolio. And then we'll look for the liquidity event, which could be any number of ways, but, selling the portfolio outright would probably be the most direct way to do it, right? So if you have a bunch of different assets in a bunch of different places across the country, you might be able to sell that property to some sort of institutional investor. And, at that time, any gain in the portfolio, as I mentioned, comes out tax-free on a federal level. And depending on the state that the client is located in and domiciled in, could quite possibly be tax-free on the state level as well. There's some states that are conforming, some states that are non-conforming. You mentioned Boston. Unfortunately, Massachusetts is what's called a non-conforming state, which essentially means that they want their money. So that would not be tax-free growth in Massachusetts, but other states it would be, depending on where you're domiciled.
So the key is that appreciation becomes tax-free as long as the property is held for 10 or longer years. That's
correct. Yes.
Yeah.
Yes. And that's a legislation piece. That's certainly not any sponsor piece. But that's part of the legislation. They wanted to incentivize longer term holdings in these opportunity zones. You actually don't have to get out after 10 years. The legislation says that you can actually stay until 2047.
Okay.
Experience tax-free growth.
So if the property is doing well, maybe the investment firm that's managing the fund will keep the property going.
Could quite possibly, yep.
Yeah. So back to the investor, our listener, who they've generated a gain. What's the time horizon? How long does the investor have to invest in these qualified opportunity zone funds?
Yeah, good question. Thanks. A lot of times they get confused with what's called a 1031, and there's certain rules around 1031 where you only have 180 days to invest, and you need to go through a qualified intermediary, things like that. That is not necessarily the case in an opportunity zone fund. There's no qualified intermediary. It also, again, is only around capital gains, and it does not include any principal. And it's also not an all or nothing proposition, right? So they don't have to do all of the capital gain. They can do part of the capital gain if they like. But to answer your question, an individual investor, going back to your Apple stock example, an individual investor would have 180 days to invest all or part of the gain into an opportunity zone from the date that gave rise to the gain, right? So, they sell that stock, they essentially have 180 days from that. Where the legislation gets a lot more loose and flexible for investors is around pass-through entities. So investors who are realizing capital gains through a pass-through must still invest all or part of the gain within 180 days. However, they can actually choose multiple start dates to start that 180-day window. All right. So they can do it on the date of sale or gain recognition, like an individual investor. They can pick on the last day of the pass-through vehicle's taxable year. So that's essentially 12/31 for most vehicles, okay? Or the due date of the pass-through vehicle's tax return without extensions, all right? So if you just take that last one, the due date of the tax return for pass-through vehicles without extensions is March 15th, okay? What that is essentially saying is an investor who had a gain in a pass-through vehicle anytime in 2022 can start their window on March 15th, and they would have till September 11th of this year, 2023, to invest in an opportunity zone. So a lot of folks who think that they're out of their window may have sold a business or have some sort of other K1 type gain. They're actually still in that investable window throughout, for the next couple months.
Yeah, so that gives gives an investor lots of flexibility, possibly, not in all circumstances, but in many circumstances.
Right. If the gain was in the right vehicle and structure, yes, it gives them a lot of flexibility.
Could you give us just an example to put some numbers on the structure and the benefits for an investor? And so could you do that? I think that might be helpful for the listeners.
Yeah, sure. I alluded to this before, but client sells an asset for $1 million on July 1st, 2023, and the capital gain is, say, $500,000, right? Just to make it easy. Tax due would be approximately $144 million.
144,000.
Excuse me, 144,000. Right. Sorry. Yeah. Let's assume that the investor puts the full $500,000 in the Opportunity Zone Fund within their 180-day timeline. The capital gain on the federal level wouldn't be due until 2026 and payable in 27, right? If they're in a conforming state, then the state level would be pushed out as well. And that would give the investor time to invest, that would give the investor the ability to invest that money and have it working for them as opposed to giving the money to the government, right? Where we are in kind of the cycle, I mentioned the recapitalization in the past. There's certainly a chance that we might be able to give some capital back before that tax is due. But, I'd say most QOZs at this point, just where they are in the build cycle, the investor's probably going to want to have an outside tax plan for that tax liability that's coming in 2027. But they will eventually see that recapitalization distribution. They're going to have cash flows from the investments, which tend to be tax efficient because you're offsetting with depreciation. And if the fund is held for 10 years plus, any appreciation on the $500,000 investment is tax-free, right? So, I like to put it in, kind of a bucket of a Roth, right? A lot of people understand Roths and know that you're paying the tax liability on that up front to have it grow tax-free. And, when you redeem it at 65 or older, it comes out tax-free to you. And that's similar to what the Opportunity Zone legislation is. You're just getting a little bit of deferral on that front end to pay the tax liability.
Yeah, I think what really makes this is an investment. So an investor, if they're taking advantage of this these Opportunity Zone funds, has to really understand they're investing in real estate, and real estate is cyclical. Sometimes it can do very, very well as an investment. Sometimes it doesn't do as well. But if it does do well, and likely over a longer period of time, it will. It could have really good results.
Yeah, absolutely. We don't disagree with that at all. You need to make sure that you're making the right investment, because if you're going to lock your capital up for a decade more, ultimately trying to get a return premium on that, you want to make sure that you're putting it in a place that you're comfortable is going to perform for you.
Yeah. I see this. There's some similarities between a 1031 real estate exchange. And I know you mentioned that a little bit earlier. And just for listeners that don't know, that's a way for a real estate investor to sell a property, but reinvest the proceeds within a certain time horizon, and defer that realized gain into the future, so that the new property basically has the initial basis of the old property, and so you're not avoiding it; you're just deferring that capital gain. And this is a little bit different. You're deferring the qualified opportunity zone is a bit different. You're deferring it only for a short period of time, just a couple of years, but then once the property gets invested, and it's that appreciation potential that really makes it sing. It's that's the tax-free part that is really exciting as far as the investor is concerned. At least that's my belief.
Yeah, and the other piece of that is that this is for many more gains other than just real estate.
Yeah.
1031 is specifically around real estate. This is for any capital gain event at all that you are going to claim on your tax return. So the appreciated stock that you mentioned, the selling the business, anything from, a classic car that you would sell and claim on a tax return, any type of gain can be put and utilized in an opportunity zone fund.
Yeah. And it doesn't need to be the full gain. It could be a portion of it.
Yeah, that's correct as well. So in 1031, it's principal first and then gain, right? So in the business example, say you started a business with $2 million and it's grown to $10 million and you sell that business, right? You can take that $2 million and do with it what you want as your basis. You can take that $8 million and choose to do $4 million in the opportunity zone today, defer that $4 million till 2026, payable in 27, and take the other $4 million liability today on your tax return in 2023. So it allows you to break up the gain liability as well. It's very, very flexible and has a lot of different use cases outside of just real estate. The part that folks get confused about is that the underlying investment needs to be with real estate, but it doesn't have to start with a real estate investment that you're essentially rolling into an opportunity zone.
Yeah, I just think it's really it's an interesting concept. I think there's application. I know, again, many of our clients and listeners have realized gains over the years, and I think some of them are interested in some tax deferral as well as that potential for tax-free appreciation. And I think, as I said earlier, the clients need to be comfortable with real estate investing, and they need to be comfortable that their assets are stay in a real estate investment for 10 years or longer. So I think that's if they're comfortable with all those things, I think it's worthwhile. I think it's worth a conversation with their accountant to determine how this might be appropriate for them, if at all.
Yeah, certainly. I don't disagree with you at all. Folks think about locking up for 10 years, and I talked about, retirement assets a little bit earlier, but essentially it's the same type of mindset, I would say. You got to be comfortable locking your assets up in the opportunity zones. In some cases, you have the potential to put capital away, sometimes at a much larger amount than you would ever be able to in any one single year, right? Depending on what your gain liability is. But you have to be comfortable with the 10 years, and you have to work with an investment professional as well as a tax professional to make sure that that's right for you. It's not up to me to say who that is right for everybody. Certainly, that's not what I'm here to say. But you got to make sure that you spend the time and do the due diligence and really be comfortable with what you're investing in and with.
Great. Well, Nino, I think this has been fascinating. I really appreciate your time and thank you for educating our listeners about qualified opportunity funds and qualified opportunity zones. I just think it's a real fascinating option for some people to think about. And thanks for your time.
Absolutely. Happy to do it. Thank you for having me.
Sure.
Well, I learned a lot.
Good. I'm glad.
Yeah, Peter, this has been fantastic. And I'll tell you, I know that you guys barely scratched the surface on this subject, but I'm glad there's a pause and rewind button on these podcasts, because if somebody's taking notes, they're going to need to pause and rewind to get more out of it. So, yeah, right. So that's fantastic. Nino, thank you so much for being such an amazing guest. Peter, thank you so much for facilitating this podcast and bringing this to us. Again, I truly do appreciate it. It was very fascinating to me. And our last thank you, of course, goes to you, listening audience. Thank you so much for tuning in and listening to the Wealth is in the Details podcast with Peter Raskin. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Peter comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually helps others find the show. Again, thank you so much for listening today. For everyone at Raskin Planning Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corp. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corp., a broker-dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln Affiliates and other fine companies. Raskin Planning Group is a marketing name for registered representatives of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.